Hello, everybody, and welcome back to another fantastic episode of Blast Off with Ribs. I am your host, Ribby Frickin' Dibs. What are we going to get into today, guys? Well, I don't want to talk about what everybody else is talking about because it's just wild. It's just wild and crazy. Everyone already knows about it. You've heard it about 1,000 times. It's about any influencers talking about. So, what are we going to talk about today? I kind of mentioned this a little bit in my last video, and I want to talk about risk management. And I found this little tidbit here on, looks like Mud, make use of, or maybe it's Moo. I don't know. Either way, here we are. We're on this thing, and really what I'm just going to go through these little titles here, the 8 crypto risk management practices, and then I'm going to personally talk about my thoughts on them. And these 8 practices are pretty good. For crypto projects, it's a little bit deeper, similar aspects, but a much deeper feel than just like a personal risk management. So company and project and corporation risk management is much different than personal investor or say so on and so forth. So having a solid plan obviously is number one. What are you going to do? This helps to reduce emotions when you are investing into things. Obviously, you want to take into account things that you like, but you want to remove the emotional aspect of it, because if you think it's going to fail, and if there's signs of it failing, you need to be cut and dry. It's yes and no. Does it check most of the boxes? Does it not check most of the boxes? What are the pros? What are the cons? Okay, having a solid plan. Only invest in what you can afford to lose. This goes for businesses as well. Businesses should not be utilizing an entire portfolio to gamble on or invest with. You want to have those reserves on hand in case catastrophic events happen. Like, you want to have enough capital on hand to outweigh your liabilities. You want to be able to pay your debts with your assets if need be. So that way you have something left over and not nothing. Or you want to break even. You don't want to end up in the red and have to owe more than you have. So only invest in what you can afford to lose. So say if you have $100 in your entire portfolio, should you be using $100 to trade with? Probably not. You probably want to use around 10% or less to trade with. So $10 or less dollars. Now, say if you lose 100% of that $10, you still have $90. You still have the majority of your portfolio left. Okay? That being said, the size of your positions. Like I was saying before, you don't want to use 100% in one trade or in all of your trades. Say if you have 10 trades, you don't want to use all $100. You want to break up that $10. You want to do 10 $1 trades. So that way, if one of those 10 trades happens to flop on you, then you have 9 other trades that will hopefully make you profit and earn back that lost dollar. So that being said, you don't want to just lose it all in one trade. That kind of defeats the purpose. Now you can take your $10 and make single trades using a portion of that $10. That's generally what I do. I use a very, very small portion of my portfolio. I don't even use 5% of I don't even think I use 3% of my portfolio to trade with, because it's too risky. And, well, the majority of the time it doesn't work out. As of lately, in the past year or so, I've been doing a lot better with my trades. I've been utilizing a lot more information, and we can go over that at the end. So the size of your positions matters. You do not want to use 100% of everything that you have. Like this is saying, I think you want to do 2% per trade. If you have the $10 out of the 100, 2% per trade, that's $2. You can make 5 trades. Limit the use of leverage. So what is leverage? So say you take your $10 and you divvy it out into 5 trades, each is $2. If you use 20%, say if you use 2x leverage, all of those trades are technically doubled, but you now have a lot more risk. You've doubled, if not quadrupled your risk, because now if you are borrowing, because you do need to borrow when you're leveraging, you are taking a short period loan from an exchange, and what you're doing is exhausting your funds before they will ever exhaust theirs. So you're ultimately giving back your money to the exchange if you do lose. So now I trade with 20x leverage with very short trades. So I will be trading for like an hour or two at the most. Sometimes it does take a little bit longer, depending upon what I'm looking at and depending upon how things change on the fly. But I'm a bit more experienced, and those trades have worked out very well for me. But I'm looking at things at a different scale than most people are. I do not recommend using leverage at all if you are new. Definitely use paper trading if you're going to be doing any type of trading. Because remember, if you do not trade with your funds, you get to keep it all. All of it. It's just now you have the price action at that point. Always calculate your risk to reward ratio, which refers to risks versus the potential return expected for a trade. So this requires a bit of technical analysis. So you can use different methods or different indicators or different calculators on an exchange's trading platform. There's generally a bunch of different tools that you can use. We can cover that in a completely different video. I do not use every single tool out there. I use some pretty basic stuff. I find that BitGet gives you more indicators than TradingView. So if you just want to go on their website and utilize a lot of their different indicators, that might be helpful. One of them that I personally like to use is the VPVR. So it gives you volume versus trades on the side of it, not just volume at each individual level or each day or each hour. It gives you it at different price points, which is kind of an interesting concept. So always calculate your risk to reward ratio, because if you have 5 trades on one token, that's not a very good risk to reward. Now, if you say you utilize, we'll just use a few: Bitcoin, Ethereum, Cardano, Shiba Inu, and Doge. Like, you want to probably spread out each one, have one different trade on them, or not at all. Maybe only make smaller trades at first, but definitely use, if you are doing any type of trading, definitely use paper trading first. Learn how to trade. Do not learn with your actual money. Use stop loss orders. So when you are making trades, whether it is with leverage or with margin or yada, 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 you want to have a stop loss. Now, some people don't. Some people watch and make very short trades, and then they will, I do this a lot. I personally don't use stop losses, but I'm not trading for that long. I'm not doing long-term trades. I'm doing short-term trades, and I'm always watching. Now, I do set up stop losses if I am making a longer trade, but this is me personally. But what I'm telling you is that you should definitely use stop losses. If you are just going to let your trade sit there and not look at it and do something else, then you should definitely be using stop losses. Because say something happens, you're not paying attention, you forget about your trade, now you come back to your computer and you've liquidated. Well, that's not good. So if you had to set a stop loss, you liquidate 100% of that trade if you liquidate. But if you set a stop loss, you could only lose like 10, 20, you can set it so that way if it triggers at a 20% loss, you only lose 20% of your trade. So if you're trading for $1, you only lose 20 cents of that dollar. You don't lose the whole dollar. I would rather lose 20 cents than a whole dollar. You save yourself 80% of your trade. Okay, so secure your profit with take profits. So like a stop loss, if you're trading to hit a certain percentage, you can trigger a take profit. As soon as it hits that price action, it will trigger it to sell, and you will earn your profit. You will take your profit. You always do that. If you think that it's going to go higher, you can always set new trades, take profit levels. So you don't need to necessarily take 100% profit at a given time. You can take 10%, 20%, 30%, 40%, and you can set those levels up until you take away the 100%. Because you take away 20 here, now you've taken away 20 and you have 80 cents left on your, your trade amount. Or you can set it so once you hit that 100, you take 50%. Now you take your dollar out, and everything else after that is, golden at that point. If you hit that 100% take profit limit and you take 50% out, now you've taken out what you've gambled with, and everything else is pure profit after that. So the last little bit is have really realistic expectations. Well, yeah, yes. If you are building your portfolio very slowly, taking those 20%, 10%, 2%, 3%, 1% gains, if you are, uncertain about a trade, you're just all of a sudden you're seeing stuff, the price action isn't going your way, you were up 20%, you didn't set to take profit at 10, and now it's at 2 to 1%, take that profit, make those smarter moves, and then all of a sudden the price drops even further. Now you didn't lose out on anything. You took that 1 to 2% profit and you didn't lose. So, having a clear, concise plan, like clear, set rules, make them hard rules. Do not be soft with your rules, because if you're being soft with your rules, you're taking emotion into effect. If something happens, bam, stop it. Stop it immediately. So this will prevent a lot of risk. It will eliminate risk. There is 100% risk in everything that you do here. So if you can eliminate some of that risk, investing is 100% risk. Like even in bonds, they're risk-free, but they're not. You can lose money on bonds. You shouldn't, but you can, and you might. So, and those are also variable. But anyways, that is it for me today, guys. If you guys have anything you guys want to talk about, let me know in the comments down below. Like, subscribe to the channel, and until next time, guys, keep blasting out.